Hello, everybody. Welcome to Macro Money, where we are going to ask, is recession the necessary price to bring inflation down? Are we going to have to take the global economy down into an outright contraction to get these prices back within some sort of a manageable range that central banks are happy with? I'm Ilya Spivak, head of global macro here at tastylive, and we are going to explore that very question today because we are going to get an updated view on global economic growth now that we've gone through the gamut of central bank announcements over recent weeks. We've heard from central banks in Australia, in Canada. We just got a 50 basis point unexpected rate hike from the Bank of England over the past 24 hours. The ECB is sounding all kinds of hawkish. The Fed paused the 10 rate hike cycle, but is nevertheless making the case that more is coming, that this is not the end. We've had 2 days now of testimony from Fed Chair Jerome Powell attempting to say as much in as loud a way as possible. And so we are in a situation here where checking in on how the global economy is doing through all of this seems like exactly the right thing to do, and right on time. The June set of preliminary PMI numbers is with us. This is a timely way to gauge where the business cycle is. GDP numbers tend to be very slow. They tend to be released only quarterly. And so it's really difficult to do anything actionable with them. These numbers are an approximation that ends up giving you a good sense of what GDP is doing, and to give you that information in a relatively expeditious way. Here we are, it is June, and we are going to get June numbers here, which is very, very helpful. The reports coming up here over the next 24 hours or so will cover Australia, Japan, the Eurozone, the UK, and the US. There's not baseline expectations for Japan or Australia, but you can see here for the Eurozone, for the UK, for the US, the story is a familiar one. Deterioration, slowdown across pretty much every metric, but for manufacturing in the US and the Eurozone, which really is a cold comfort considering both of those numbers are sub that critical 50 boom bust level. PMIs work on a logic around 50, where 50 is neutral, above 50 is expansion, below 50 is contraction. The further you go above 50, the faster that expansion. The further you go below, the faster the contraction. So if you consider, for example, the UK manufacturing PMI number, the move from 47.1 to 46.8 implies manufacturing will shrink in June and at a faster rate. Whereas if you look at, let's say, services in the Eurozone, the move from 55.1 to 54.5 means services will grow, but at a slower rate. So the picture here looking very, very sobering indeed. And when we consider what it is that we're looking at here, collectively about 50% of global growth, and when we consider how many economies are dependent on demand from the US, say, or the Eurozone, which is, of course, a ton. Canada, say, a G10 economy, almost completely dependent on the U.S. A lot of Asia and the Asia Pacific region dependent on what's going on in the U.S. as well. A lot of Central Europe depending on what's going on in the Eurozone, the Nordic economies as well. So the reach here well in excess of even that 50% or so that these economies, these five economies, add up to. So a very critical story and a very critical moment to be having the conversation, given what global central banks have been doing so far in June. So let's consider what all of this looks like. Here's the U.S. as a as a starting point. And we can see here a pattern that will recur across many of these economies. You can see manufacturing is in contraction mode and has been noticeably weaker than what's going on in services. Services, of course, the dominant part of most of these economies. The spread is something like 75-25 in most developed economies for the share of services relative to the share of manufacturing, give or take. It's really more like 70-20 and about 10% agriculture. Again, painting with a really broad brush here. Some countries are more so agricultural, some countries are less so, and that will happen on a country-to-country, region-to-region differentiated basis. But the general story is that services is somewhere in the vicinity of 3/4 of the economy, well over half in pretty much every major market. And so what you see is, while manufacturing is weak, the composite that captures both sectors in the overwhelming majority of the economy tends to cling to what services are doing because services are relatively dominant. And so the story in the U.S. is one where manufacturing remains weak, services, and thereby the overall economy, are looking quite strong. In fact, near the fastest levels of economic activity expansion in a year. It's a very similar story in the Eurozone. Here, manufacturing looking even more hampered, services, and the composite number appear to have cooled over the past couple of months and are expected to cool again here in June, but still looking rather buoyant relative to recent history. We're at levels that were persisting somewhere around April, May, June of last year. So again, give or take, we are looking at something that is close to the strongest growth rate in a year. And that's after the aggressive rate hike cycle that central banks have been on. Even in perpetually hampered UK, where we are looking at probably some of the weakest economic conditions in the major economies, same baseline story. Weak manufacturing and a stronger service sector uplifting the overall economy to about levels comparable with a year ago. Here's the full global picture. Now, this doesn't have expectations for the June number, but as we can see here, up through May, the story is a familiar one. It is precisely what we see in these expectations. Strong services, anchoring a strong overall pace for economic activity. Once you throw developed markets in here, you can see this is the global average. We're actually at some of the strongest growth that we've seen in perhaps closer to a year and a half, even approaching 2 years. And manufacturing is in contraction. Now, it hasn't materially deteriorated in the past several months. It seems to be broadly idling at this point at a global level. But nevertheless, sub 50, it is a slow, not particularly severe, but a bleed out nonetheless. This is in contraction. So, how does one explain this divergence? You can see it's quite dramatic at this point. You can see typically the story over the past several years. We begin here, not surprisingly, from around where the COVID crisis crests and starts to turn, that these things have been moving much closer together than what we're seeing now. It hasn't been usual for manufacturing and services to diverge like this. And nevertheless, the gap is now quite wide. So what is going on and what does it mean? Well, that manufacturing looks weak seems only to make sense. We've seen that the actions that central banks have taken to increase interest rates all in the effort of beating inflation, have had at least some of the intended effect. In the dark line there, global trade volumes, the sum of global exports and imports, just to get a sense for the degree of activity. Not necessarily who benefits or who costs, or where you get the deficit, where you get the surplus once these flows net out. More so looking at how much appetite is there to be buying and selling things and to ship them across borders. What does global demand look like? So once you look at the cumulative volume number, you can see the dampening effect of higher rates as the Fed begins to lift borrowing costs. And of course, we've talked about why the Fed is so important here, even relative to other central banks, even relative to a country's local central bank, because the Fed, of course, is the steward of the dollar. When it increases rates, it increases the cost of borrowing dollars, and most global activity is transacted in dollars. So what the Fed is doing here then is increasing the cost of financing virtually any form of economic activity in any country you can think of. Shock of shocks, the result has been a slowdown in that activity because financing it has become more expensive. So at the margin, at least some of it has stopped making sense. So what you then have is, not surprisingly, with some lag here, disinflation. As financing costs have gone up, economic activity has slowed. With about a 7-month lag behind that slowdown, inflation at a global level has started to ease. So seemingly nothing to see here. There is a slowdown in economic activity. That's exactly what central banks are bargaining for. The goal of that has been to bring inflation down. It is, in fact, going down. Also, one might ask what the problem is. And that seems to be this. When you look at how this process is expected to continue, with so many central banks still well above their inflation targets, which tend to be somewhere within a 1% to 3% range, you end up with some troubling signs. The red line here, the average of 10-year break-even rates across the developed economies, and I've used exactly the 5 that are going to be reporting on PMI in these next 24 hours. So Japan, Australia, Eurozone, UK, and the US. And we've used the 10-year break-even because that one is liquid for all 5. So you can get some decent and some representative market action here. You can see that inflation expectations were going up with the recovery from COVID as that economic activity picked up. Not surprising there from about the end of the first half of 2020. We can see also that coming into the beginning of this year, with central banks tightening efforts, now about a year old, inflation expectations have stopped falling. They crested toward the beginning of last year, right in line with the cresting of global economic activity here. CPI, as you can see, followed with a bit of a lag, 7 months behind economic activity, 6 months behind these expectations. And what you then see is, while CPI has been on this lagged path down, expectations are signaling that progress has stalled, that disinflation is running into a wall. Now, ostensibly, the reason for this seems to be exactly what we just saw in this chart right here, that the global economy is still relatively strong, despite the damage done by rate hikes up to this point, which you can clearly see on the manufacturing side of things. We can see that on the service side, there is sticky strength, and that seems to be keeping inflation from continuing to go lower. Now, why is it that services then is sticky? Well, one could make the argument that this is the place where fiscal stimulus during the COVID era was the most concentrated because, of course, it really focused on putting money in the hands of consumers, and most of that has been targeted at services. You can talk about pent-up demand. After COVID reopening, much more has gone towards services, which were things that were not as available, like restaurants or live performances, say, or travel during COVID lockdowns, whereas goods, of course, one could ship to one's home. And so that demand was perhaps more vulnerable, this demand perhaps less so. For whatever reason, services have proven to be much more resilient, and that's a problem for keeping inflation sticky, because since services are such a dominant employer of most of the economy, what this means is that resilience in the largest employer speaks to locking in wages at relatively higher levels, because this is the place where most hiring is occurring in major economies. And of course, wages don't easily adjust back down. So what happens in these places is an inflationary cycle that's not easy to get free of, as we've seen the level of response in manufacturing relatively straightforward. It is not that here, where if on the good side you might ship less of whatever it is you were importing, you're certainly not going to announce to your workforce in most cases that their wages have been adjusted down for inflation. No, typically this is a situation that will require economic pain and an adverse adjustment in labor markets. We've been seeing that in spades in just the past several rounds of economic data from the U.S., where we can see there is still a significant mismatch in the supply and demand of labor that is still underpinning inflation. We can see it's come down from a very heady reading, near 9%, down to 4%. It's still well off the Fed's target of 2%, and much of that is this mismatch between supply and demand for labor, which of course necessarily hits heaviest in the service sector because most labor is in the service sector. And that has clearly created some stickiness in inflation expectations. We just saw a similar story in the UK, where we have much tighter labor market conditions than average. It's not quite the deficit that we have in the US. Here you can see supply significantly undershooting relative to demand. In the UK, we can see there's still a bit of excess supply relative to demand, at least on 3-month average terms. But if we look at the trend average before COVID, which is about a 5 handle, and then currently, which is about a 2 handle, then what we're looking at is about 50% less room, less flexibility in the labor market than usual. Not surprisingly, that too has been inflationary. And that presents a very interesting question as these PMI numbers cross the wires. Because what we then end up with is, first of all, an economic slowdown. That much is there. Indeed, we can see with the overall direction of these PMI numbers, the trend is lower. We can see also that there's been some cresting even on the services and composite side. That is perhaps to some extent encouraging, but also that what central banks wish to achieve is plainly not being achieved here. That progress will require a further down payment to continue. And what that speaks to is perhaps that these PMI numbers might reveal a global economy that, if it remains as it looked in May, is just not slow enough to get the progress on inflation moving as central banks would like it. Another important bit in this narrative seems to come from the economic surprise index, which is just perking up above its 20-day moving average. Now, this is a measure of how economic data flow out of the major economies is doing relative to baseline forecasts. When the data does better, the index goes up. When the data does worse than forecast, the index goes down. It's helpfully also scaled by volatility. So the more market moving the surprise, the more the index moves in a given direction. You can see it has been deteriorating since early this year, and now seems to have turned a corner. We have seen this movie before. The last time that we decisively broke the 20-day moving average on the upside for this index, we ran in a whole long line into the kind of crescendo that we saw at the February-March part of this story, when, of course, the Fed aggressively had to signal that it is going to be more hawkish. The markets read it at face value. They pushed the terminal Fed funds rate that was expected somewhere into the direction or in the orbit of 6%. And that, of course, ended up being just enough pain to trigger a banking crisis and tip over SVB and First Republic, force a hasty tie-up of UBS and Credit Suisse, and just variously shake the financial system. We're perhaps looking at a turn in the economic data in a positive direction again, if that's something that will ultimately transpire as it has before, and if this break has legs. That, of course, is exactly the opposite of what global central banks want to see. They want to see inflation expectations continue to head lower. Now that they're anchored here, seemingly, if these PMI numbers, in line with what we're seeing with this surprise index, register a bit warmer, register less bad, especially for the service sector, than is what's currently anticipated, well, then the story might not be nearly as positive as the numbers would suggest at face value, because the reaction function from central banks would then be, well, we're being taken further off course. So what we need to do is tighten these screws further. And so the reaction function from central banks might well mirror what we saw from the anticipatory rate hikes, unexpected ones, by the way, by the RBA and the Bank of Canada this month. The unexpectedly forceful rate hike from the Bank of England just overnight. The aggressively hawkish rhetoric from the ECB, effectively pre-announcing the next hike for July already at this month's meeting. And all of the fireworks we've heard from Fed commentary last week around the policy announcement, this week around Fed Chair Powell's testimony, and probably next week when he speaks again. So if this data does relatively better, the upshot would be almost more dire than if it actually started to comply and decelerate. Because from the market's perspective, forward-looking as they are, The response would be, well, we know what this data means. It means higher interest rates for a longer period of time. And so the upshot is probably negative for stocks, negative for cyclical commodities, negative for anything out along the risk spectrum. Certainly something like crypto comes to mind, negative for non-yielding assets or assets that are historically on the opposite side of rising yields. That speaks to gold, that speaks to the Japanese yen. Where you might get strength in this environment, interestingly enough, is the US dollar. And we talked about this framework before. In an environment where you have a relatively weak U.S. economy, and that would be one increasingly squeezed by ever more hawkish Fed action, given the makeup of things as we look at them here today, you typically see a stronger dollar, not a weaker one. And that's because the dollar is that ubiquitous global unit of commercial exchange. So it is uniquely liquid. And of course, the more liquid something is, the less volatile it is. So if the markets are becoming worried about the kind of situation where global central banks are going to clamp down harder, cyclical assets look weak, and there is a wave to liquidate, there is a cashing out to get away from this broad malaise, what's the currency of choice to cash out into? Ostensibly the one that's the least volatile in a negative environment. And because of its liquidity, that's the dollar, which could be in a position to capitalize as all of this comes together. And that is Macro Money for today. It's the last episode for this week. We are here Monday through Thursday every week right after Overtime, which is a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, recapping the day's events, trying to figure out what they mean and where things are going there from. I'll be on with Chris for Futures Power Hour tomorrow, as I am every Friday, and then back on with Tom and Tony on First Call Sundays. They might be out if memory serves this Sunday, so it'll be Chris and I again. But typically it is Tom and Tony for First Call on Sundays. Outside of those shows, I am on Twitter, opining at Ilya Spivak. Thank you very much for joining. Good luck trading out there. Macro Money will be back next week. Take care.